Hello, my name is Jacqueline Broers, Deputy Portfolio Manager of Utilico Emerging Markets. We've just got back from another highly insightful week's trip to mainland China and Hong Kong, where we managed to have a number of really useful meetings with Hong Kong and Chinese-listed utilities and infrastructure companies. One of the biggest takeaways from our trip was confirming our view that the outlook for China continues to remain challenging, and it's really difficult to see how in the short term this is going to improve. It is very clear when being on the ground that consumer sentiment continues to be poor and the outlook for the property market remains challenging. One question during the trip that we continue to ask was, how is the economic outlook going to improve? In our opinion, it remains clear that the Chinese government is not doing enough. Yes, since we've returned from China, we have seen the Chinese central bank announce a full package of policy stimulus on the back of the continued poor economic data and a federal interest rate cut. The question, though, is this enough to restore confidence and to revive demand? The newly announced policy stimulus includes lowering the 7-day repo rate by 20 basis points to 1.5%, lowering the required reserve ratio for banks by 50 basis points to an average of 6.6%, which is in the hope that it will inject around 1 trillion RMB liquidity in order to stimulate consumer spending. The government has also lowered the mortgage rate and down payment ratio to boost the property market. Again, though, we doubt this will be enough. Some of these policies are a first in Chinese history. For example, the setup of a 500 billion RMB stock stability fund, which will allow funds, brokers and insurance companies to tap central bank liquidity to buy stocks. Despite this, in our view, the Chinese government needs to start to embrace more fiscal, long-term measures such as the reduction of personal tax rates, increased fiscal expenditure, and reset the distribution of fiscal revenue and responsibilities between the central and local governments, as this remains unbalanced. At present, the local governments bear too much fiscal expenditure, whilst the central government benefits from fiscal revenues. However, the Chinese government have started to indicate more of a willingness to provide additional support, all of which is a step in the right direction, but the pace of which needs to be accelerated. Consumer confidence remains too low. At UEM, though, we continue to look for opportunities that we believe will benefit from the long-term underlying structural growth drivers and infrastructure megatrends. Opportunities we believe will be able to weather the macro Chinese headwinds include Kunlun Energy, a city gas distributor sitting under the PetroChina umbrella. The company is well placed to benefit from China's transformational industrial growth in the long run, given natural gas will continue to play a pivotal role in Chinese energy transition process. And Sunny Vision, the largest data center operator in Hong Kong. They should continue to capitalise on the accelerated digital infrastructure trend within the region, supporting Hong Kong as a regional data hub and a strategic gateway to mainland China. Overall, in this challenging market, we continue to take the highly selective bottom-up approach with a focus on investment opportunities and returns that are aligned with government agenda and are well placed to capture the structural gains.